In this video, we're gonna cover everything you need to know about the so-called free fund portfolio. While most people put so much effort trying to find the best stocks to buy using complicated tables and reading through news and financial statements, what I also used to do, by the way, using the free fund portfolio, you're gonna get the best diversification and final return by using just 3 broad-based index funds that cover both the stock and the bond markets. You're gonna have a fund that covers the US stock market, a fund that covers the international stock market, and a fund that covers the bond market. The US stock market is going to be the part that will give you the highest growth. The international market will give you a higher diversification because you are not only dependent on the success on one single country. And the bond market is your safe section. Basically, stable bonds that will give you some safe cash flow and should actually keep a stable price over time. The biggest advantage that you have through this diversification is a stable growth that doesn't look like a roller coaster because of market downturns. As you may know, if you're an investor, your biggest enemy is not the stock market, but your emotions. That's why a mix of stocks and bonds diversified with national and international markets is the best way to give you peace of mind and avoid making costly mistakes. So let's talk about the 5 main benefits of the 3 fund portfolio. The first is that it's simple. You only buy 3 funds and suddenly you own over 22,000 different securities worldwide in the stock and the bond market without overlap amongst your investments. You don't have to think about how much you allocate in each sector because the funds do it for you. So no more headaches, no more paradox of choice between thousands of different stocks or index funds, and still an above average performance. The second benefit is the great diversification. When it comes to diversification, all the great investors seems to have different ideas, but in reality, they're spreading the same message. Ray Dalio, for example, says that diversification is the holy grail of investing because it protects you in every phase of the market cycles. Warren Buffett instead said that diversification is protection against ignorance. It makes little sense if you know what you're doing. But if you reflect on these two statements, you actually find them to say exactly the same thing. If we are not incredible investors like Ray Dalio or Warren Buffett, with all the resources and knowledge they have, we are all actually kind of ignorant about the stock market. I mean, just look at how most hedge funds can't beat the market, and you can realize that most likely we're not going to. So if we are investing in an index fund that holds like 4,000 different stocks, some companies inside the fund may go wrong, but others will compensate. Alright, the third benefit of the 3 fund portfolio is the cost. The average expense ratio of these funds is going to be around 0.05% to 0.1%. That means that for every year, if you have, for example, $10,000 portfolio, you're gonna pay between $5 and $10 fees on average, which is gonna help your total returns a lot. So I created a tool that calculates the effect of the expense ratio on your investments. If we assume to invest $100,000 with a 4% annual return and we let it compound yearly, we can calculate how our portfolio grows if it has an ongoing fee of 0.05%, 0.5%, or 1%. Notice how the fees affect investment portfolio over 20 years. Between 0.05% and 0.5% expense ratio, you have a loss of around $20,000. While between 0.05% and 1%, the loss over the same period would be almost $40,000. Lucky for us, the 3 fund portfolio is going to be composed of funds with the lowest expense ratio possible. So yeah, you're gonna save thousands and thousands of dollars only thanks to that. The fourth benefit is that there is no financial advisory fee because you're not using a financial advisor. By the way, I'm not a financial advisor, but if you like my content, you can help me out with a beautiful like to this video. You know, that white, ugly thumb up symbol over there, that you can make a beautiful black. So thank you very much for doing this. It really helps the channel a lot. Thank you. Anyway, financial advisory fees are usually high and will eat into your returns. But in this portfolio strategy, you're only going to be investing in passive index funds. So no financial advisors in the way. Alright, the fifth and the most important benefit of the 3 fund portfolio is that it never underperforms the market, as opposed to most actively managed funds. Since it's tracking the broader market, you're putting your money into most of the stocks and bonds that exist in the world. And as I showed at the beginning, most studies prove that most active fund managers usually underperform the market. This chart from the Motley Fool shows, for example, how the average hedge fund performed compared to the S&P 500. And they actually underperformed every single year from 2011 to 2020. So these are the 5 most important benefits of the 3 fund portfolio. Let's see now how to construct a portfolio. In this part of the video, you'll see which funds you need to invest in depending on the brokerage you have and also on the country. Here's a table I made that shows you where you can invest, and as you can see, you can buy ETFs or index funds. Basically, ETFs are usually lower cost and more tax efficient than index funds and can be traded throughout the day like stocks. So I kind of prefer those, but you can choose yourself. So if you buy ETFs, you're gonna need VTI, VXUS, and BND. VTI is the Vanguard Total Stock Market Index Fund ETF and covers the whole American stock market. VXUS is the Vanguard Total International Stock Index Fund ETF and covers the international market. And BND BND is the Vanguard Total Bond Market Index Fund ETF, which covers the bond market. As for trading app, you can buy this on any brokerage or trading app in the US, like Robinhood, M1 Finance, or Webull. If instead you live in Europe, you need a European equivalent. ETFs in Europe trade under the so-called UCITS, which is the main European framework for investments like ETFs or index funds. In Europe, you can use, for example, Trade Republic, the Giro, or Scalable Capital as trading apps. It's free and easy to register, and you're gonna find the links to register for free in the description below. And for most of them, you're also gonna get a free welcome bonus by using these links. So in Europe, you're not gonna have all the choices that you have in the US, but let's see what the equivalents are. And the closest European equivalent to VTI ETF is Vanguard S&P 500 UCITS ETF. I'm not giving you the ticker because it changes depending on if you buy it in pounds or euro and with accumulating or distributing dividends. But basically you can just search this in any European app and you're gonna find it. Vanguard S&P 500 includes the 500 best companies in the US and not the American stock market. However, since both indices are weighted by market size, the performance is almost the same. Now, moving to VXUS, there isn't exactly an ETF in Europe that tracks the same index. However, since your goal with these first two ETFs is to create a global portfolio with an overweight in the US, you can achieve it by picking an all-world fund like the Vanguard FTSE All-World UCITS ETF or the iShares MSCI ACWI UCITS ETF, along with the S&P 500 ETF that I told you before. Now, as for BND, which is the bond index, you should go for the iShares US Aggregate Bond UCITS ETF. This tracks the same index as BND, which covers the American bond market. If instead you want to track the whole bond market instead of only the US market, you can go for the iShares Core Global Aggregate Bond UCITS ETF. Now, if you live in another country which is not Europe or the US, write me a comment down below and I'll try to find the equivalent for you. Now, moving to the index funds, you can see that if you have a specific brokerage open like Vanguard, Fidelity, or Schwab, there are specific index funds that you can buy as well. So with Vanguard, for example, you can buy VTSAX, which is a total stock market index, VTIAX, which is the International Market Index Fund, and VBTLX, which is their Bond Market Index Fund. Fidelity instead offers index funds with zero fees, which is great. So if you invest with them, you're gonna go for the FZROX for the American stock market, FZILX for the international stock market, and FXNAX for the bonds. For Schwab instead, you can get SWTSX, SWISX, and SWAGX. Now, in case you wanna buy index funds but you use another different brokerage, just write it in the comment section below and I'll tell you which one you have to take. Now, the last thing is some of the index funds will have minimum investment requirements. So if you want to avoid that, just go for the ETFs. Alright, let's take a look at some historical data and see how these different asset allocations perform. Since the 3-fund portfolio is often recommended by Bogleheads, which is a community of investors which are fans of Jack Bogle, the founder of Vanguard, in their forum there is someone that has been updating the results of the portfolio every single year, and here's the results from 1997 to 2022 in 4 different cases. 80-20 means 80% in stocks and 20% in bonds. Then we have 60-40, 40-60, and 20-80. If you look at the results, you can see that for the most part, the years are positive. And depending on the asset allocations between stocks and bonds, you'd have had between 1997 and today an annual average return between 5% and 8%. Not every single year is going to be a positive year for your portfolio, but still, whatever attempt you'd make to try to buy or sell stocks or ETFs to avoid these downturns would most likely make you lose money in the long term. But in general, as for any investment, you shouldn't look at the short-term perspective because in the short term, really, nobody really knows what's going to happen with the stock markets. But since I don't want you to lose faith in the stock markets only because it went down in 2022, here's a great chart from JP Morgan that shows the yearly return of the American stock market from the 80s to today. And you can see that despite some bad years with an average drop of 14.3%, the annual returns have been positive for most of the time. Now let's talk about asset allocation, namely how to decide how much of the pie is going to go into stocks versus bonds. How much you should allocate for each one of these funds depends on a few factors like your risk tolerance, your age, your goal, and your time horizon for your investments. In general, as I showed you with the table before, an overweight in stocks is going to give you a better return in the long term, but will also cause bigger ups and downs because it's more volatile. So risk tolerance is surely the main factor here. The common rule for asset allocation by age is that you should hold a percentage of stocks that is equal to 100 minus your age. So if you're 40, for example, you should hold 100 minus 40, meaning 60% of your portfolio in stocks. Now, since life expectancy is growing though, I'm gonna change the rule to 110 minus your age. But the truth is, you need to decide yourself based on how much downside you can stomach in bad market times. In the description below, I'm gonna give you the link to get the table with the historical results and the graph for free, so that you can look at it and try to get an idea of which allocation you'd be comfortable with based on the historical downturns. In the same file, I also created a tool for rebalancing your portfolio every year, but we'll talk about that later. Now, in terms of the most common asset allocations for the 3-fund portfolio, here are the most commons that you can find in www.boggleheads.org. From the most aggressive to the most conservative, the first one is an 80-20 portfolio, and it will consist of 64% US stocks, 16% international stocks, and 20% bonds. Less aggressive is the 60-40, with 48% US, 12% international, and 40% bonds. Then an equal portfolio that would have 34, 33, and 33%, although I would always prefer to have more weight in the US stock market than the international. Then we have a conservative portfolio, 40-60, with 32% US, 8% international, and 60% bonds, as well as an extra conservative 20-80 portfolio with 14% US stocks, 6% international stocks, and 80% bonds. To make it simple for you, in the free tool that you find in the description below, I created a table that gives you the exact percentages based on your age. So for example, if you are 30 years old, you'd have 64% in US stock, 16% in international, 20% in bonds, which is, by the way, the 80-20 portfolio. And in fact, if you do 110 minus 30, which is your age, you get 80. Now, you might be wondering why we're not 50-50 in terms of US stocks versus international stocks. And the reason is that international stocks are considered more volatile and add complexity because of the currency exchange. In addition, a lot of international markets aren't as developed as the United States. Alright, now we got to the last part of the video, which is, by the way, one of the most important. Rebalancing your portfolio every year is important because the 3 funds are going to give you different returns. So if you start with an 80-20 portfolio, after 1 year, those percentages are going to be different and they need to be adjusted. I haven't found any video that gives you a tool to easily calculate how to rebalance your portfolio, so I did it myself, and this easy file tells you exactly how much you have to sell and buy of the 3 funds to get to the percentages that you need. So let's say that you start with an 80-20 portfolio and you invest $10,000. At the beginning, you're gonna have 6,400 in US stocks, 1,600 in international stocks, and 2,000 in bonds. Now, after 1 year, you wanna rebalance your portfolio and you find yourself, let's say, with $8,000 in US stocks, 1,700 in international stocks, and 1,800 in bonds. Through the tool that I'm giving you, it's gonna be really easy, and you just need to fill in the orange cells. First of all, as we've seen before, you can write your age, and the tool gives you the suggested allocation. You can still decide your own allocation and write it here, even if it's different. Now let's assume that we want the same, so we're gonna write here 64, 16, and 20. In your portfolio value, you write exactly how much you possess right now in your portfolio, and in our example, it's gonna be 8,000 in US stocks, 1,700 in international stocks, and 1,800 in bonds. So as you can see, your current allocation is not right anymore. And here you see exactly what you need to sell and what you need to buy of the 3 funds. In particular, in this case, you must sell $640 of the US stock market fund and buy $140 of the international stock fund and $500 of the bond fund. If you do so, this is your final result and you get back exactly to the desired allocation of 64, 16, and 20. If this tool is going to be useful for you, I'd really appreciate a like to this video to help me with the YouTube algorithm. And whatever comment you have, you can write it in the comment section below or write me an email. Now, rebalancing doesn't mean that you're withdrawing money from an investment portfolio. And if you do a rebalance with a tax-advantaged account like a 401k or even a Roth IRA, you might not even pay taxes on that until way later. Moreover, if I can give you a piece of advice, you should try to invest consistently every month using the dollar cost average method, because this way you're completely free of decision-making stress. More likely, you're gonna have a better return in the long term. Next week, I'm gonna publish a video in which I'll show you another 3-fund portfolio that has a little tweak that makes it even better and is better suited for US investors. So don't forget to subscribe to the channel and ring the bell so that you'll be notified next week when the video is out. I wanna thank you very much for watching this video, everyone. I wish you a great day or evening, and as always, I'll see you in the next video. Ciao!